Very good afternoon to all of you. Today, I would like to discuss about fund flow statement. Though I have already discussed the beginning part of the fund flow statement in my previous lecture, I have already discussed you about the fund, about funds from operation, about schedule of changes in working capital. The only part left, that is fund flow statement, how to prepare fund flow statement. But I will discuss first the recap of fund, flow of fund, schedule, and thereafter fund flow statement. So, what is fund? I have already discussed you that there are two ways to define fund. One is when you define fund in a narrow sense, and other way you define fund in a broad sense. In narrow sense, जब हम इसे संकीर्ण विचार से सोचें, then we define fund as cash. तब हम इसे केवल कैश जो मेरे पास है उसे हम फंड कह सकते हैं. And when we define fund in a narrow sense as cash, then in this situation we are supposed to prepare the statement. The name of that statement is known as cash flow statement. But when we define fund in a broader sense, then we can consider not only cash but the other assets also which is very near to cash, means which in a very short period which may be converted into cash, like the amount of sale on credit basis, because sales are of two types. One is cash sales, other one is credit sales. Cash sales is the sales, the money which you are receiving immediately at the time of sale. But when we sold goods on credit basis, then the payment is postponed, then the amount which you are receiving, the amount which you will not receive at the time of sale, because you are providing trade facilities to the person to whom you sold goods, that is the person who is your debtors. Maybe trade period around is 3 months, means after 3 months you will recover the cash from the debtors. So that amount of debtors also be considered as fund, because after certain period of time you will get the cash. Another fixed assets, the fixed assets which is suppose of no use, or maybe which is of obsolete nature because of the change in technology, and you want to sell. So that type of fixed assets which you want to sell after a certain period of time, you will get cash. So that fixed assets also be considered as fund. It means not only cash but the assets which is very near to cash be considered as fund in a broader sense. And if you define and if you define fund in a broader sense, then we are supposed to prepare fund flow statement. Is that clear? Now, why we prepare fund flow statement? We prepare fund flow statement to know the changes in working capital. Why? This changes in working capital you cannot get from other statement like income statement or balance sheet or position statement. No. So what will you get from position statement or income statement or PL account? From PL account you will get the net profit or net loss, income or expenses. we will consider in income statement. And what about position statement? Position statement will prepare with the help of balance sheet. And in the balance sheet, we will consider how much amount of assets and liabilities you have. So these either balance sheet or PL account will not give you the information of changes in working capital. Okay, so that is the reason we prepare fund flow statement. So what sort of factors you consider in fund flow statement? In fund flow statement, there are again two sides. Like balance sheet, there is source and application. In income statement, in PL account, there is expenses and income, debit and credit side. But in fund flow statement, neither there is debit side and credit side, nor assets and liabilities, but there is source and application. So how you know that this is source or application? How you will get the information of source and application? Very good question. The source you will get, or application, the information of application you will get with the help of 2 years balance sheet, not with the help of 1 year's balance sheet. Oh, so is it? It means there is need of 2 years balance sheet to prepare fund flow statement? Yes, there is need of 2 years balance sheet to prepare fund flow statement. So we cannot prepare fund flow statement with the help of 1 year's balance sheet. How could it be? Because if I have 1 year's balance sheet, suppose I have the fixed assets of 10 rupees. How could it be possible to know that whether the fund is coming inside or fund is going outside the business? Very difficult, you cannot get. But if you have the balance sheet of 2 years, and if the fixed assets amount, suppose in 2019 is 10 rupees and 2020 is 15 rupees, then you will get the information. What sort of information will you get? In 2019, the amount of fixed assets is 10. And 2020, the amount of fixed assets is 15. It means the amount of fixed assets is increasing. How could it be possible that amount of fixed assets will increase? Very easy. You have to spend money. If you spend money, obviously, before you have one house, the amount of one house is 10 rupees. And other house you have purchased of rupees 5, so amount of building become 15 rupees. And 2 building you have now. Why? Because you have spent the money. The fund has gone outside. You have utilized the fund. So with the help of 2 years balance sheet, what sort of information you got? That is application of fund. How much application of fund? 5 rupees. For what reason? Purchase of fixed assets. Is that clear? So in this way we came in conclusion that fund flow statement we will prepare with the help of 2 years balance sheet. Clear? Now, this fund flow statement you prepare to know the changes in working capital. And what is working capital? Working capital is the difference between current asset and current liabilities. That is excess of current asset over current liabilities. Oh. So there is need to prepare one statement, one schedule, which is known as schedule of changes in working capital. Means from the balance sheet, you collect all the informations of current assets and current liabilities, and you see the effect of that current asset and current liabilities on working capital. If the current assets is increasing or decreasing, current liabilities is increasing and decreasing. So if the amount of current assets will increase, it is very obvious that working capital will increase. If the amount of current assets will decrease, working capital will decrease. If the amount of current liabilities will increase, reverse. Working capital will decrease. If the amount of current liabilities will decrease, working capital will increase. Is that clear? If you do not understand, then I can show you one example. Suppose this is working capital is equal to current asset minus current liabilities. If the amount of current asset is suppose 5 and current liabilities is 2, then working capital is how much? 3. Now what I told you, that if the amount of current assets will increase, other factors remain same. So if the amount of current assets increase means, suppose this is 5 and this is 6. Increasing 5 to 6, current liabilities remain same. Current assets is increasing. Now you see the impact of this increase of current assets on working capital. How much working capital will be? 6 minus 4, 6 minus 2 is 4. It means what? Working capital increases. Right? Now if the amount of current assets decrease, this is your base. Now here we have increased. Now I'm changing. I'm decreasing from 5 to 4. Current liabilities remain same. Now this is what? Because current assets is decreasing, so current 4 minus 2 is 2. Current working capital is decreasing. Is that clear? It means current assets increases, working capital increasing. Current assets decreases, working capital decreasing. Now you take the other example. Considering current liabilities. Now current assets remain same. Current liabilities is changing from 2 to 3. Current liabilities is increasing. 5 minus 3, this is 2. This is what? This is, here is 3, here is 2. Decreasing. Here it is increasing and here working capital is decreasing. Now this is 5. Now I am decreasing from 2 to 1. This is increasing. Now this is decreasing. 2 to 1. 1 means decreasing. 5 minus 1 is 4. And this is what? This is increasing. Now here say, here is 3 and here is 2, decreasing. Here is 3, here is 4, increasing. Here is 2, here is 3. Increasing, here is decreasing, here is decreasing, here is increasing. So in this way what happened? In this way we came in conclusion that if the current assets is increasing, working capital will increase. Decreasing current assets, working capital will decrease. Current assets, current liabilities increasing, working capital reverse relationship, working capital will decrease. Current liabilities is decreasing, working capital will increase. So after this you will get the last conclusion that how much it affects on working capital in 2019 and 20. If suppose after deducting current liabilities from current assets, you will get current working capital of 2019, and thereafter you calculate the working capital after deducting current liabilities of 2020 from the current assets of 20. You will get the working capital. Now you see, if suppose working capital of 2019 is suppose 10 and working capital of 2020 is suppose 15, it means what? 10 to 15, it means working capital is increasing. So increase in working capital, 5 rupees. Is that clear? Now I have discussed you in the previous class about funds from operation. In funds from operation we have discussed that funds from operation is also known as adjusted profit and loss account. Why? Because we prepare fund profit and loss account generally. That the profit and loss account which we prepare, from that PL account, profit and loss account, we calculate net profit. What do you think? That net profit is the sources which you are generating only from operation? Not at all. Why? Because the net profit which you calculate from profit and loss account is the combination of inclusion of non-operating income and gain or non-operating expenses and losses. Means that income which has no relation with operation, like rent received, dividend received, interest received, which has no relation with operation. And this non-operating income which we are adding on the credit side, that is in gross profit. Profit on non-operating gain, that is profit on sale of shares, profit on sale of fixed assets, This is your gain. That also you are including in gross profit, and you are considering on the credit side of the PL account. And by that amount, your net profit is increasing in PL account. In the same way, non-operating expenses and losses. On the expenses side of the PL account, we write first non-cash charges. The charges which you are not paying anyone in the form of cash, like depreciation. Depreciation of what? Depreciation of fixed assets. Because we are using the fixed assets, so the book value of the fixed assets every year decreasing by deducting the annual depreciation. So by deducting annual depreciation from the fixed assets, you will get the book value of the current year. So because we are deducting depreciation, so at this moment of time, we are considering that depreciation under the expenses side, that is debit side in the PL account. We are considering as an expenses. And by that amount, your net profit is decreasing. The same way, non-operating loss or non-operating expenses, that is expenses on issue of shares. Because at the time of issuing shares or debentures, there is some expenses incurring, which has no relation with operation. And this expenses on issue of shares or debentures, we are considering on the expenses side of the PL account, and by that amount your net profit is decreasing. Non-operating loss, loss on sale of fixed assets, loss on sale of shares and debentures, that we are considering as an expenses on the PL account, and by that amount your net profit is decreasing. Loss due to theft, loss due to fire, loss due to earthquake, loss due to flood, natural calamities, and by that amount your net profit is decreasing. So at the time when we calculate funds from operation, we have to re-add back those items that is decreased, that decreasing the fixed net profit in PL account. We will deduct those items that will increasing the net profit in PL account. So at the time when we prepare funds from operation, we will just take the amount of net profit from PL account, and thereafter we will add what? Add those items which is decreasing the net profit in PL account, and which factor is decreasing the PL account in net profit, net profit in PL account, that is non-operating expenses and losses and non-cash charges. So in net profit, we will re-add back the amount of depreciation, amount of expenses on issue of shares, loss on sale of fixed assets, loss due to theft, fire and natural calamities. This amount we will re-add back as and when you want to calculate funds from operation. Then what? Then we will have to deduct. What we want to deduct? Those items that will increase the net profit in PL account. Which factors is increasing the PL account, net profit in PL account? Non-operating income and gain. So there is need to deduct those items, that amount at the moment when you want to prepare funds from operation. That is less non-operating income and gain. And thereafter, whatever the amount you will get, that amount will give you the informations of funds from operation. Is that clear? Now, at the end, we will prepare fund flow statement. In fund flow statement, as I told you, that there are two sides. One is sources side and other one is application side. So fund flow statement is also known as sources and application of fund, or sources and uses of fund. Application means you are using. Sources means what? The source from where you will get the fund. That is where got fund. That what are those resources from where you are getting the fund. And what is application? Where gone fund. That is where the fund has been utilized. You have used the fund. That is fund gone. Where gone fund. So this fund flow statement also be known as where got, where gone fund. Sources is also known as, that is inflow of fund and outflow of fund. Sources means inflow and application means outflow. Now, these sources are of two types. One is internal source, another one is external source. Internal source means the source which you are generating within the operation. And within the operation we are generating the net profit. But the net profit which we calculate in PL account is, because that net profit is not the real funds from operation, so there is need to readjust. There is need to adjust that net profit. And that is the reason this fund from operation, also known as adjusted profit and loss account, which I have already discussed you. The amount which you have calculated as fund from operation separately, then you take that amount and you write the amount here. You can write the fund from operation details here also, but it will make your fund flow statement very clumsy. So better you prepare that fund flow statement, fund from operation separately, and you take the amount of funds from operation from that place and you write the amount here also. In this way, this fund from operation here you have written in one line and it looks good, beautiful. And if the person want to see from where this amount will come, has came, so you can say that is in working or that is in extra 1, 2 or 3, whatever. There the details of this XXS been written. Now the external source, and if the operation, fund from operation is positive, then it becomes source. But when the fund from operation is negative, then it will be on the reverse side, that is on application side. If it is minus. Obviously, if the fund from operation is positive, it means it will be your source, which you can use. But if the fund from operation is negative, obviously that you have to write on the reverse side, that is on application side. Now the next is external source. External source means the source which you are generating externally to run the business, to procure the fund, to start, for investment. As you know, there are two types of long-term fund. That is owner's capital and debt capital. In owner's capital, there are two types of capital: equity share capital and preference share capital. Equity share capital is also known as common stock, and preference share capital is also known as preferred stock. This is share capital. After that, that is debt capital. What is debt capital? That is debenture, bond, long-term bank loans. These are debt capital. So these are your external, long-term external source. Now the external source, what you write and how you write. In external source, if the amount of, suppose if I take the amount of balance sheet, or I can remove this because I have to. If suppose in balance sheet, suppose this is 1990, 2019, 2020, 2019, 2020. If this is your liability side, this is your asset side. If suppose fixed assets of suppose fixed assets 10 and 13, it's increasing. Increasing means what? How it increases? It means in 2019 you have 10 rupees of fixed assets in 2020, the amount of fixed assets will increase from 10 rupees to 13 rupees. It means 3 rupees of fixed assets has been increased. It means we have purchased some new building of rupees 3. Now you have 2 building. How you have 2 building? Because I spend money. Because I have utilized my fund. I have utilized my 3 rupees to get another building. So the amount of fixed assets I have now, not 10 but 13. So this 3 rupees, which side you want to write? Consider in PF fund flow statement. Obviously on application side. On application side, which type of changes you have seen? That fixed assets has increases or decreases? Increases. So increase in fixed assets will be considered on the application side of the fund flow statement. So increase in fixed assets. That is, fixed assets increases how much? 3. You should write only 3, because with the help of 2 years balance sheet, we came in conclusion that your fund has been utilized, that is 3 rupees, to purchase the fixed assets. Now, if I consider here equity shares, that is long-term fund. Long-term fund means, suppose equity share capital. Equity share capital is 8 and 13. It is 8 and 13 means what? Why 8 become 13? 8 became 13 because you have issued new shares. Why you have issued new shares? Because we are in need of fund for expansion, diversification, modernization, replacement of the old machine with the new one. So there is need of fund, so I have issued new shares. So when you will issue new shares, then what happens? Then you will get the cash, because the person who will invest will give you cash. So that become your source. So there is increase of long-term fund. An increase of long-term fund will become source. So increase in long-term fund, that is issue of equity shares or preference shares or debentures, that is how much? 5 rupees. Now if say preference shares, that is 10 to 6. 10 to 6 means what? Decreasing. Why decreasing? Because you have already paid the money to the preference shareholder. Now the preference share capital being decreased from 10 rupees to 6 rupees, or 10 crores to 6 crores, or 10 lakhs to 6 lakhs. So what happened? We have utilized, we paid the money to the preferred stockholder of 4 crores or 4 lakhs or 4 rupees. So in this way, which side you want to consider this 4 rupees? Application side or sources side? That is application side. Because we have utilized the money. We have utilized the fund. Then only the amount has been decreased from 10 to 6. So this side you have today, right? That is redemption of preference shareholder capital, that is how much? 4 rupees. Here the issue become 5, but redemption become 4 on the reverse side. Now you say, if suppose, this is suppose land and building, fixed assets. This is suppose land and building, and plant and machinery. Suppose 8 to 4, 8 to 5. Amount is decreasing. How decreases plant and machinery? Earlier you have plant of 8 rupees, now the amount of plant has been decreased from 8 to 5. Why and how? Decreasing or increasing fixed assets, maybe due to depreciation and sale or purchase. But at this moment, we are not considering depreciation. If we are not considering depreciation, there is only purchase and sale. So what happened here? Amount is decreasing, it means there is need, that it means you have sold one of your plant, maybe which is of obsolete nature. So sold means what? Sold means you got the fund. And when you got the fund, it means it become your source. So here, decrease in fixed assets. Decrease in fixed assets, sale of fixed assets. Of how much? Sale of fixed assets of 3 rupees. Okay? It means you have seen the increase in fixed assets, you have seen. Decrease in fixed assets, you have seen. Increase in long-term fund, you have seen. And decrease in long-term, you have seen. Increase in long-term fund becomes source. And reverse, opposite. Decrease in fixed assets becomes source. Because decrease in fixed assets will give you cash or fund. And increase in long-term fund will give you fund. But decrease in long-term fund means you are utilizing your fund. And increasing in long-term, increasing in fixed assets means utilizing your fund. It means you have seen the increase or decrease in fixed assets and increase or decrease in long-term fund. Now the two factors remains from the balance sheet. Because in balance sheet there is 4, that is fixed assets and current assets, and long-term fund and current liabilities. Fixed assets and long-term fund you have seen. There is only 2, increase or decrease of fixed assets and increase and decreasing of long-term fund. Now increase and decrease of current assets and increase or decrease of current liabilities, that you have already considered in schedule of changes in working capital. And in schedule of changes in working capital, you have already calculated increase or decrease in working capital. Now whatever the amount we have calculated, that you keep it in your mind. Now here is what, suppose funds from operations, suppose is 9 rupees. Suppose decrease, suppose this is total is 16. Suppose this also be 16. But this is your 4 plus 3, 7. In 7 half, and this is 16. So the balancing figure of fund flow statement is what? That is increase or decrease in working capital. Which side is heavier? Sources side is heavier. In your pocket, how much fund? You have 16 rupees. How much application you have? How much out of 16, how much you have utilized? You have utilized only 7. How much remain in your pocket? That is 7 rupees. This 7 rupees is what? This 7 rupees is, because sources is heavier than application. So this balancing figure is increase in working capital. An increase in working capital will be on the application side of the fund flow statement. So here is increase in working capital. And this is what? This is your balancing figure. And when this balancing figure of your increase in working capital, if it will match with the amount which you have calculated in schedule of changes in working capital, then you be assured that this calculation will be is 100% correct, and you will get 10 out of 10. Is that clear? So the fund flow statement is clear, about fund is clear, about schedule of changes in working capital, about fund from operation. If you will see my previous lecture, that is fund flow statement number 2, you will get the detail of all that. So here also we have given the recap. So if there is any problem, you can raise questions. You can put your comment in the comment box of